Welcome to my channel. 3 days of red, markets bleeding, investors panicking, and then, overnight, everything flipped. And if you don't understand why that happened, you are going to miss what comes next. And what comes next could be the most important financial move of 2026. Stay with me, because by the end of this video, you're going to see something in today's market that most people are completely overlooking. Welcome back. Today is March 5th, 2026. And if you checked the markets yesterday and felt confused, you're not alone. Because what just happened is not random noise. It is not a dead cat bounce. It is not a lucky day. What happened yesterday is the visible surface of something much, much bigger happening underneath the market. Something that started quietly, picked up momentum, and is now starting to show up in prices in a way you cannot ignore. We are going to break it all down today. The real catalyst, the specific stocks that are leading this, what the data says happens next, and here's the part most finance channels won't cover today. What this entire situation means for gold and silver, because those two metals are telling us something critical right now. Let's go. So first, what actually happened? Because the headline said, markets recovered, like it was some kind of miracle. It wasn't a miracle. It was a data point. Yesterday morning, the ADP private sector jobs report for February dropped, and it came in above expectations. Now I know, jobs report, that sounds boring. Stick with me because here's why this number is like oxygen to a market that was suffocating. For the past several weeks, the one thing keeping investors up at night has been this question. Is the US economy actually slowing down? And that question is not paranoid. It is completely valid. Because here's a number that almost nobody is talking about right now. The US economy grew at just 1.4% annualized in the fourth quarter of 2025. 1.4%. Compare that to the third quarter, where we grew at 4.4%. That is not a small slowdown. That is a cliff edge. And it was caused by government spending falling and exports dropping, both of which are directly connected to the trade war that is now escalating. Because on top of the GDP slowdown, Treasury Secretary Scott Bessent confirmed this week that Trump's 15% global tariff is now going live. Not a threat, not a negotiation chip. Live. Real. Already affecting prices. So when investors woke up yesterday, they were already nervous. GDP slowing, tariffs kicking in, Middle East tensions spiking oil, and then the ADP jobs report lands above expectations. And the services inflation data cools at the same time. That combination told the market one critical thing. Consumers are still employed, still spending, and a recession is not here yet. And when a scared market gets even one piece of good news, it doesn't walk toward the exits. It sprints toward the stocks it's been waiting to buy. And the stocks it sprinted toward were not random. Micron Technology, up over 5% yesterday. AMD, up over 5%. Amazon, up nearly 4%. Tesla, up 3.4%. Nvidia, up 1.7%. These aren't just tech stocks that had a good day. These are the exact companies sitting at the center of something that Bank of America is calling a semiconductor supercycle. And it's worth understanding what that phrase actually means because it changes how you see everything happening in this market right now. A supercycle is not a regular business cycle. A regular cycle goes up, peaks, comes down, and repeats. A supercycle is a structural, decade-long shift in demand that doesn't reset. It's the kind of thing that only happens a few times in a generation. The last time we had one was the internet build-out of the 1990s. Before that, the mainframe revolution of the 1960s. Right now, we are in the middle of the AI supercycle, and it is not slowing down. Bank of America is projecting global semiconductor sales will hit $1 trillion in 2026. That is a 30% year-over-year increase. $1 trillion in 1 year in one industry. That doesn't happen in a normal market. That happens when every major company on the planet is simultaneously racing to build AI infrastructure, and all of it runs on chips. Now let's talk about Micron specifically because this is the stock that went up 5% yesterday. And I think a lot of people still don't understand what this company actually does right now or why it matters. For years, Micron was the boring memory chip company. The kind of stock your dad held in a dusty portfolio and forgot about. Revenue was cyclical. Margins were thin. Nothing exciting. Until AI came along and changed everything. Because the chips that power AI, Nvidia's GPUs, AMD's accelerators, Google's custom processors, all of them require something called high bandwidth memory, HBM. Think of it like this. If the AI chip is the engine of a Ferrari, HBM is the fuel system. Without it, the engine doesn't run. And right now, demand for HBM is so far ahead of supply that companies like Micron cannot build it fast enough. Their revenue jumped 56% in their last reported quarter to $13.6 billion. Their CEO is guiding to $18.7 billion this quarter. Earnings estimate revisions for fiscal 2026 are up 78%. For fiscal 2027, up 91%. And here is the number that made a Wedbush analyst compare buying Micron right now to finding a Mickey Mantle signed baseball card at a garage sale. Despite all of that growth, Micron still trades at just 12 times forward earnings. The S&P 500 as a whole trades at over 25 times. This company is growing at 56% and still costs less than half the market average to own. That gap doesn't stay open forever. AMD's data center revenue was up 14% year over year last year. Its stock climbed roughly 77% in 2025. Nvidia, a company that made $26.9 billion in revenue in 2022, is now projecting revenues around $213 billion. Its Blackwell Ultra server shipments are expected to double throughout 2026. And analysts estimate Nvidia's free cash flow over the next 3 years could reach $500 billion. $500 billion in free cash flow from one company. The money being poured into AI infrastructure is unlike anything we have ever seen, and we are still in the early innings. But here's what I want you to understand. And this is the part that nobody is putting together right now. The stock market surging, the semiconductor boom, the tariff chaos, the slowing GDP, all of these things are connected, and they are all pointing to the same thing happening in one specific market. A market most stock investors aren't even watching. I'm talking about gold and silver, and what those two metals are doing right now should terrify you if you're not paying attention, and excite you if you are. Let me give you a number that will put everything into perspective. 1 year ago, gold was at $2,624 an ounce. Today, March 5th, 2026, gold is trading at approximately $5,153 an ounce. That is a gain of more than 100% in 12 months. Gold has essentially doubled in 1 year. It set dozens of new all-time highs throughout 2025, averaging close to one new record per week. And the crazy thing is, almost none of the drivers behind that move have gone away. If anything, they are accelerating. There are 3 forces pushing gold right now, and they are not normal market forces. They are structural. Force number 1. Central banks. Governments around the world, China, India, Poland, Turkey, and others, have been aggressively building their gold reserves. They are moving away from US dollar assets and toward gold. This is not a trend. This is a geopolitical strategy playing out in real time. And when central banks buy, they are not trading. They are accumulating for decades. That demand does not flip off on a bad day. Force number 2. Federal Reserve expectations. The market is pricing in multiple Fed rate cuts throughout 2026. When rates fall, the opportunity cost of holding gold goes down. Gold becomes more attractive relative to bonds. That is a powerful mechanical tailwind. Force number 3, and this is the one that ties back to everything we talked about today: geopolitical risk. Treasury Secretary Bessent had to address Persian Gulf oil flows this week because the conflict in the Middle East is directly threatening supply chains. When the world feels unstable, money flows to safety. And gold is the most universally recognized safe haven asset on the planet. It has been for 5,000 years. That doesn't change because someone invented a new algorithm. So where does gold go from here? JP Morgan is forecasting an average price of $5,055 per ounce by the fourth quarter of 2026. ANZ has raised their Q2 target to $5,800. In bull case scenarios with continued central bank buying and ETF inflows, some analysts are modeling $6,350 per ounce by year-end. Could gold pull back short-term? Absolutely. The rally has been relentless and positioning is stretched. But every analyst covering this metal is saying the same thing. Dips in gold right now are buying opportunities, not warning signs. But here is where it gets really interesting. Because if gold has already doubled, silver might just be getting started. Silver in 2025 surged approximately 147%. It broke above the $50 per ounce level that had capped it for decades, a resistance level so stubborn it became almost mythological in trading circles. After breaking $50, silver ran past $70. And now analysts are staring at $100 as the next major target. Here's why silver might actually be the more compelling story right now. Gold is a monetary metal. Investors buy it for safety. That's it. Silver is different. Silver is both a monetary metal and one of the most important industrial metals on Earth. About 60% of annual silver demand comes from industry, electronics, solar panels, medical devices, and increasingly, the components that go inside AI hardware and electric vehicles. Think about what we just said about the AI supercycle. Every new data center being built, every AI chip being manufactured, every Nvidia GPU being shipped, all of that hardware requires silver. Silver is one of the best electrical conductors on the planet. You literally cannot build the AI infrastructure boom without it. And here's the supply problem that very few people are talking about. The silver market has been running at a structural deficit for multiple consecutive years. Demand is exceeding mine supply by somewhere between 160 and 200 million ounces every single year. New mining projects are not coming online fast enough. One analyst said publicly he would not be surprised to see silver reach $175 per ounce or higher. The math is not crazy. A structural supply deficit, industrial demand from AI and clean energy, and monetary demand from a world full of geopolitical uncertainty. Silver has every ingredient of a historic price run. The key risk to understand: silver amplifies gold's moves in both directions. If gold corrects, silver will correct harder. If gold resumes its climb, silver's upside could be even more explosive. That's the trade-off you need to know. So let's bring this all together. Where are we, and what should you be watching? The market is at a crossroads right now, and I mean that literally. There are two roads, and the data coming in over the next 2 to 3 weeks will determine which one we take. Road 1. The AI supercycle overwhelms the macro headwinds. Jobs stay strong. Tariff impacts are manageable. Earnings from Micron, AMD, and Nvidia continue to beat. The market reads all of that as confirmation that the tech infrastructure build-out is too big and too funded to be derailed by trade policy. Semiconductors have another leg up. The AI supercycle shifts from a great narrative into an undeniable market reality. Road 2. The tariff impact starts showing up in the data. Jobless claims start climbing. Costco and Kroger warn on margins today. Companies start pulling guidance. The GDP slowdown gets revised down instead of up. In that scenario, yesterday's rally gets erased quickly, and we see a real test of how strong the conviction in tech actually is. My honest take: the AI build-out is real. The demand for chips, the money being committed, the CapEx being deployed by Amazon, Google, Microsoft, Meta, that is not going away regardless of what tariffs do short-term. The structural story is intact. But if you're making moves based on yesterday's rally alone, that is not a thesis. That is hope. Watch the jobless claims today. Watch what Costco and Kroger say on margins. Watch whether the Fed signals anything on the rate path in coming weeks. Those are the 3 signals that will tell you whether yesterday was the start of a real sustained recovery or just a relief rally in the middle of a larger correction. For gold, the 3 structural forces are not going anywhere. Use short-term volatility as an opportunity. For silver, understand what you own. It is more volatile, more sensitive to industrial conditions, and will move harder in both directions. But if you believe in the AI build-out, the clean energy transition, and a world that keeps getting more unstable, silver at current levels could look extraordinarily cheap in 12 to 24 months. Here's the big picture I want you to walk away with today. The market did not just randomly flip. It flipped because the underlying story, the AI infrastructure build-out, the semiconductor supercycle, the structural demand for the hardware that runs our digital world, is stronger than the fear that was pushing it down. That story got a single piece of confirmation yesterday, and the market responded immediately. That is how a market behaves when the underlying conviction is real. Most people watching the market today are reacting. They see a green day and feel better. They see a red day and feel scared. What separates investors who actually build wealth from investors who just ride the emotional roller coaster is the ability to understand what is happening underneath the surface and make decisions based on that, not on yesterday's closing price. That's what we do here. If this gave you a clearer picture, hit that like button and subscribe. Drop a comment below and tell me, are you watching semiconductors, gold, or silver right now? I'll see you in the next one.